When people ask me about the future of the US dollar, I can hear what they're really asking underneath it. They're not asking about a currency. They're asking whether the ground is still solid, whether the thing that has held everything up for so long can keep holding it up. And I understand that feeling because I've felt it myself, not just about money, but about my own certainty. The uncomfortable question isn't, will the dollar collapse? The uncomfortable question is why we keep needing the word collapse in the first place. Why do smart people swing between believing something is unbreakable and believing it is about to fall apart? Why do we want the future to be either safe or ruined, as if reality has to choose one of those stories for us? I've learned sometimes the hard way that reality usually doesn't move in the dramatic way our emotions prefer. It moves in mechanics. It moves in incentives. It moves in slow shifts that feel invisible until they don't. I'm going to speak about this the only way I know how, not as a prediction, not as a warning meant to scare you, and not as a comfort meant to calm you. I'm going to speak about it as a system because currencies don't die the way people talk about them. They weaken, they strengthen, they get tested, they earn trust, and they lose it. And trust doesn't disappear in a single day. It erodes in patterns, in cycles, in choices made over time. There is something I've seen again and again. People confuse intelligence with understanding. They think if they read enough, if they follow enough data, they can reach certainty. But the most important thing is not the data. It's how you think about it. It's whether you can look at what is true without needing it to confirm what you want to believe. That's a principle that matters in investing and it matters in life. Truth over ego, systems over events, cycles over moments. I didn't start with that principle. I arrived at it because I had to. When I was younger, I was confident in my ability to see what was coming. I had that feeling many young people with some early success get. You think your mind is a spotlight, and if you aim it correctly, the path will be obvious. I built Bridgewater with a belief that if I could understand the machine, I could navigate it. And I did begin to understand parts of it, but I also learned something that surprised me. The better you are at explaining yourself, the easier it is to stay wrong. In the early 1980s, I made a call about the economy that I believed in strongly. It wasn't a casual opinion. It was a structured view supported by reasoning that felt airtight to me. I spoke about it. I positioned for it. I carried it with the confidence that comes from thinking your logic has captured reality. Then reality pushed back. Not in a philosophical way, but in the simplest way possible. The outcomes didn't match the view. Prices moved against the position. The environment wasn't what I thought it was. And instead of adapting quickly, I did what many intelligent people do when reality disagrees with them. I tried to rescue the idea. I remember that period as a narrowing. Your world gets smaller. The range of acceptable information shrinks. You find ways to interpret everything through the lens you're already committed to. You become attached not to what's true, but to what you've already said. And then slowly you start losing not just money, but optionality. Clients leave. People you respect stop calling, the firm contracts, and eventually you find yourself in a quiet room with a simple realization: being smart did not protect you. In fact, it made you more vulnerable because it made you better at defending the wrong thing. Bridgewater nearly disappeared. I had to let people go. I had to face the possibility that the thing I built might end, not because of some unavoidable external event, but because I was wrong and couldn't let go fast enough. That's a humbling place to be. Not because it's tragic, but because it's clarifying. There's no room left for self-image. Reality doesn't care about your intentions or your intelligence or your identity. It cares about cause and effect. I don't tell that story because I enjoy looking back at pain. I tell it because it reshaped the way I relate to uncertainty. It taught me that the most dangerous thing isn't being wrong. The most dangerous thing is being wrong while feeling right. And that feeling certainty can be more intoxicating than anything else in markets. So when people ask me about the future of the dollar, I don't begin with headlines. I begin with mechanics because mechanics are what humbled me when my story failed. The dollar is not just paper. It is a claim on value. a claim supported by a country's productivity, its institutions, its credibility, its ability to raise revenue, its willingness to honor obligations, and the world's willingness to hold that claim. When you say the dollar, you're really talking about a relationship between the United States and everyone who uses its money as a store of value, a medium of exchange, and a reserve asset. That relationship has been strong for a long time. People forget what makes it strong. They treat it like a law of nature. It isn't. It's the result of history and power and trust and the structure of global trade and finance. It's also the result of the fact that when fear rises, people still tend to run toward U.S. assets, not because the U.S. is perfect, but because, relatively speaking, it has offered a kind of deep liquidity and institutional continuity that the world has relied on. But here's the part that is hard for people to sit with. Strength and vulnerability can exist at the same time. A system can be dominant and still be accumulating imbalances. A currency can be the world's reserve currency and still be facing long-term pressures. And the question isn't whether the dollar will vanish. The question is whether the mechanics that support trust are improving or deteriorating over time. When a country spends more than it earns, year after year, it finances the difference. That financing can come from borrowing, and borrowing means issuing debt. Debt is not evil. Debt is a tool. In the right amount, it's productive. In the wrong amount, it becomes a claim on the future that grows heavier with time. The world doesn't wake up one day and decide it hates a currency. The world simply adjusts to the changing balance between the claims being issued and the real value that supports them. I've watched people react to debt the way they react to storms on the horizon. Some deny it because they don't want to be anxious. Others obsess over it because anxiety makes them feel prepared. Most don't look at the structure. They don't ask how the debt is funded, who holds it, what the maturity structure looks like, how interest costs interact with deficits, how the central bank responds, how politics shapes choices, how confidence moves through global markets, like a current you can't see until it shifts. And there's something else. When debt becomes large enough, choices narrow, the system becomes more sensitive, policy becomes more reactive. That's when people start talking about money printing as if it's a switch you flip. It isn't. It's a set of actions taken to manage the relationship between debt, growth, interest rates, and stability. Sometimes those actions prevent immediate pain, and sometimes the cost shows up later in ways people didn't expect. The future of the dollar will not be determined by a single event. It will be determined by choices made repeatedly under pressure across years. Choices about spending, borrowing, taxation, monetary policy, and the maintenance of institutional trust. It will also be shaped by the rest of the world because a reserve currency is not a domestic phenomenon. It's a global contract, and contracts are renegotiated implicitly, not announced. I'm aware that what I'm saying can feel abstract, but the reason it matters is very simple. If you build your life on something you assume is permanent and it turns out to be cyclical, you will be surprised in the worst way. That was my mistake early on. I believed my view was right because it made sense. I learned to ask instead whether the mechanics supported it. That same shift applies here. Not what you hope will happen, not what you fear will happen, but what the machine is doing and what it tends to do in similar circumstances. I can feel the temptation people have to want a clear answer, yes or no, safe or doomed. I can also feel my own resistance to giving that kind of answer because it's not how reality works. The truth is quieter than certainty. It usually is. And when you learn to live with that, you begin to think differently. You begin to prepare rather than predict. You begin to respect cycles rather than deny them. You begin to hold your views with enough humility that you can change them without breaking yourself. As I kept studying these systems, both professionally and personally, I noticed something that made me uncomfortable in a familiar way. The debates around the dollar often sounded less like analysis and more like identity. People weren't just defending a currency. They were defending a sense of stability, a sense of continuity, a belief that what worked during their lifetime should keep working indefinitely. I understand that instinct. I've had it myself. It's human to want the ground beneath you to stay where it is. But systems don't care about our attachment. They respond to incentives and constraints. And over long periods of time, those forces tend to outweigh narratives, even powerful ones. When I look at the dollar, I don't ask whether it is good or bad. I ask what pressures it is under and how those pressures typically resolve. That perspective didn't come naturally to me. It came from being wrong enough times that I learned to stop moralizing outcomes. Markets aren't rewards or punishments. They are feedback mechanisms. There was a point years after the early collapse of Bridgewater when I caught myself feeling a familiar confidence returning. We had rebuilt, the principles were working, the systems were stronger, and there was a subtle temptation to believe that the hard part was over, that we had finally earned the right to trust our conclusions more than our doubts. That's usually when reality checks you, again, just in a quieter way. I remember reviewing a set of positions during a period when the global environment was shifting. The data supported our view, but the outcomes were muted. Things weren't breaking, but they weren't behaving the way they had before. It was tempting to dismiss that as noise. Instead, we slowed down. We asked what had changed structurally, not what we hoped would revert. That habit, pausing instead of pushing, is one of the most valuable things I ever learned. The same habit applies to thinking about reserve currencies. Historically, reserve currencies don't lose their status because people suddenly panic. They lose it because the underlying economics gradually stop justifying the same level of confidence. Trade balances shift, debt accumulates, military and economic power redistribute. Alternatives, imperfect as they are, slowly become less unthinkable. The British pound didn't disappear overnight. It faded as the world changed around it. The institutions remained, the language remained, even the pride remained, but the mechanics no longer supported the same role. When you study that transition, what stands out is how long people believed it couldn't happen and how calmly it happened once it did. That's why I'm careful with dramatic language. Collapse is rare, transition is common. And transitions are uncomfortable precisely because they don't offer clear signals. They create a long middle period where the old system still works well enough to rely on, but not well enough to ignore its weaknesses. That ambiguity is hard for human psychology. We want resolution. Systems don't provide it on demand. I've also seen how policy choices are shaped by short-term pressures. Leaders respond to voters. Central banks respond to markets. Markets respond to incentives. And incentives don't always align with long-term stability. This isn't a criticism, it's an observation. When debt levels are high, the tolerance for pain is low. That shapes decisions in predictable ways. Sometimes those decisions buy time. Sometimes they trade future flexibility for present calm. What matters is not whether those choices are right or wrong in isolation, but how they interact over time. A series of small, reasonable decisions can accumulate into a large structural shift. That's true in organizations, in lives, and in monetary systems. You don't notice the change while it's happening because each step feels justified. Only in retrospect does the pattern become clear. I've learned to pay attention to that pattern, not because it gives me certainty, but because it gives me context. Context is underrated. It doesn't tell you what will happen. It tells you what kind of things tend to happen under similar conditions. And that's enough to change how you behave. When people ask me what they should do about the dollar, I notice they're often looking for a trade, not a principle. They want to know where to move their money, not how to think about risk. I understand that urge too, but the more enduring question is how much of your life is dependent on a single assumption remaining true. That's the question I wish I had asked myself earlier in more areas than investing. One of the quiet lessons I took from my early failures is that concentration feels like confidence until it becomes fragility. Whether it's a position, a worldview, or a currency, relying too heavily on one outcome, working out exposes you to a kind of risk that doesn't announce itself until it's too late. Diversification in the broadest sense isn't about maximizing returns. It's about staying whole when the world changes in ways you didn't anticipate. I don't mean diversification as a checklist. I mean it as a mindset, a willingness to accept that you don't know which future will arrive, and a decision to respect that uncertainty rather than fight it. That mindset has served me better than any forecast ever did. There's also a personal dimension to this that's easy to miss. As you get older, you realize how many of the things you once thought were permanent were simply stable for a while. Careers, relationships, regimes, currencies. That realization doesn't have to make you cynical. It can make you more careful with your assumptions and more compassionate with your expectations. I don't lose sleep over the dollar, and I don't assume it will remain unchanged. Both extremes come from the same place, the need for certainty. What I try to do instead is stay attentive, to watch the mechanics, to notice when pressures build and when they release, to remain flexible enough to adjust without drama. That approach isn't exciting. It doesn't make for bold headlines, but it's consistent with how reality tends to operate, quietly, gradually, until it isn't. As time went on, I began to notice how often people mistake visibility for importance. Headlines move quickly, markets react loudly, but the forces that shape outcomes over decades tend to work below the surface. They don't announce themselves, they accumulate. And when I think about the future of the dollar, that's where my attention naturally goes, not to what's being debated today, but to what's quietly compounding underneath it. One of the most persistent misunderstandings I see is the idea that money printing automatically leads to immediate inflation or immediate collapse. Reality is more subtle than that. When money is created, what matters is where it goes, who receives it, and how it changes behavior. Sometimes it flows into productive activity. Sometimes it inflates asset prices. Sometimes it simply prevents a system from seizing up. The consequences can be delayed, uneven, and hard to trace. That delay is precisely what makes the process dangerous. When cause and effect are separated by time, people underestimate the connection. I've seen this dynamic not just in currencies, but in organizations and in personal lives. When something seems to work without obvious cost, we assume it's sustainable. We extend it. We rely on it. And gradually we become dependent on conditions staying favorable. That's not a flaw in intelligence. It's a flaw in how humans experience time. At Bridgewater, one of the disciplines we developed was to separate what felt good in the moment from what was sustainable over the cycle. That wasn't easy. There were periods when policies or positions reduced short-term pain but increased long-term risk. The temptation was always there to take comfort now and deal with consequences later. What changed for me was realizing that later is not abstract. Later is simply now arriving slower than expected. When governments run persistent deficits, they are making a similar trade-off. Again, this isn't a moral judgment, it's a mechanical one. Deficits can stabilize demand, they can smooth downturns, they can support growth in fragile moments. But over time, they increase the stock of claims on future income. Servicing those claims requires either higher growth, higher taxes, lower spending, or some form of monetary accommodation. Each path has consequences. None are painless. And the choices made reflect not just economics, but political and social tolerance for discomfort. What often goes unsaid is that reserve currency status provides flexibility, but it doesn't remove constraints. It allows a country to borrow more easily and for longer. It allows imbalances to persist, but it also increases the scale of adjustment when confidence eventually shifts. That's why I'm cautious with binary thinking. The dollar doesn't need to lose its status for pressures to matter. Even small changes in behavior, in portfolio allocations, and reserve preferences can ripple through the system. I remember a period when we were analyzing capital flows and noticed something subtle. There wasn't a dramatic exit from U.S. assets. There was a gradual diversification, more alternatives being considered, more questions being asked, nothing alarming on its own. But together they told a story, not of panic, but of reassessment. That kind of shift rarely shows up in a single data point. It shows up in correlations, changing in sensitivities, increasing in the system, becoming more reactive to stress. This is where thinking in systems matters. Events don't cause outcomes on their own. They interact with existing conditions. A high debt environment reacts differently to shocks than a low debt one. A polarized society responds differently than a cohesive one. A mature power faces different trade-offs than a rising one. These contexts shape how the same event plays out. Ignoring them is how people get surprised. There was a time in my life when I believed that if I could just get the model right, the uncertainty would disappear. That belief didn't survive contact with reality. Models are simplifications. They are maps, not territory. They help you see relationships, but they don't eliminate risk. What they can do, if used honestly, is show you where you are vulnerable. And vulnerability is more useful than confidence. When I think about the dollar, I think about vulnerability in that sense. Where is the system sensitive? Where does it rely on continued trust? Where are the feedback loops that could amplify stress? None of this requires predicting collapse. It requires respecting fragility. There's a difference. For someone listening to this, the practical implication isn't to abandon one currency or embrace another. It's to notice how much of your own stability depends on a single narrative staying true, whether that narrative is about money, a career, a country, or a belief about how the world works. The more tightly your sense of safety is bound to one outcome, the less room you have to adapt when conditions change. One of the quieter lessons of my life has been learning to hold my views lightly, not because they don't matter, but because reality has the final say. When you accept that, you stop trying to force clarity where none exists. You focus instead on robustness, on flexibility, on staying in the game long enough to adjust. I don't see the future of the dollar as a verdict. I see it as a process, a set of evolving relationships between debt growth policy and trust. That process will produce periods of stability and periods of strain. The mistake is assuming one excludes the other. As I've gotten older, I've grown more comfortable with that ambiguity, not because it's comforting, but because it's honest. And honesty over time is more useful than certainty. As the years accumulate, something shifts in how you relate to questions that once felt urgent. They don't disappear, but they lose their sharpness. You stop needing them to resolve quickly. You become more interested in whether you are positioned to respond well rather than whether you can be right ahead of time. That change didn't come to me through insight. It came through repetition, through watching cycles unfold slowly, then all at once, and recognizing the familiar shape beneath the surface. When I think about the dollar now, I don't experience anxiety. I experience attentiveness. Anxiety narrows your thinking. Attentiveness widens it. Anxiety wants answers. Attentiveness wants understanding. That distinction matters, especially in periods when systems are stretched and narratives become louder than mechanics. One of the hardest lessons for me to internalize was that stability is not the absence of change. Stability is the capacity to absorb change without breaking. That applies to people, institutions, and currencies. The dollar has absorbed many shocks over decades: wars, recessions, political shifts, financial crises. Each time it adapted. That history is real. It deserves respect. But history is not a guarantee. It's a data set. What weakens systems over time is not stress itself, but the accumulation of unresolved imbalances. When pressures are continuously deferred rather than addressed, the system becomes more sensitive. It reacts more strongly to smaller disturbances. You see this in markets when leverage builds. You see it in organizations when problems are postponed. You see it in personal lives when difficult conversations are avoided. The pattern is consistent. I've watched intelligent people mistake adaptability for permanence. They see that a system has adjusted in the past and assume it will always adjust in the same way. But adaptation often comes with a cost. Flexibility today can mean fragility tomorrow if it relies on stretching the same mechanisms again and again. At some point, the margin thins. There were moments at Bridgewater when we had to confront this directly. Strategies that had worked for years began to show signs of strain, not failure, but fatigue. The temptation was to optimize harder, to push the existing framework further. Instead, we stepped back and asked a more uncomfortable question. What if the environment had changed enough that the old approach, while still valid, needed to be complemented rather than extended? That kind of adjustment is difficult because it feels like admitting that past success is no longer sufficient. That feeling shows up in larger systems too. Reserve currency status confers advantages, but it also creates expectations. The world builds around it. Trade settles through it. Assets are priced in it. That embeddedness makes change slow but not impossible. When change does occur, it tends to be incremental until it isn't. Not because of a single decision, but because of cumulative strain. There's a tendency to frame discussions about the dollar in moral terms: deserving or undeserving, responsible or reckless. I've learned to avoid that framing. Moral judgments obscure mechanics. The dollar's future will be shaped by productivity, demographics, fiscal choices, monetary responses, geopolitical realities, and global alternatives. None of these forces care how we feel about them. They interact whether we acknowledge them or not. If there is a principle that has guided me well, it's this focus on what you can see clearly and prepare for what you can't. That doesn't mean withdrawing. It means not overcommitting to a single path. It means recognizing that resilience comes from balance, not brilliance, from optionality, not conviction. For someone listening quietly, perhaps late at night, trying to make sense of where the world is headed, I would say this without emphasis. Pay attention to your assumptions, especially the ones you rarely question. Ask yourself which parts of your life depend on stability continuing exactly as it has, not to frighten yourself, but to understand your exposure. That understanding alone can change how you move. As I've aged, I've also become more aware of how short our individual timelines are compared to the systems we inhabit. Currencies outlast careers. Empires outlast lifetimes. And yet, within those long arcs, individual choices still matter. They matter most when they are made with humility, with awareness of limits, and with respect for forces beyond our control. I don't feel urgency to resolve the question of the dollar's future. I feel responsibility to observe it honestly, to notice when pressures build, to notice when adjustments occur, to remain flexible enough to adapt without needing a narrative of victory or failure. That stance doesn't produce certainty, but it does produce alignment. And alignment over long periods has proven more valuable to me than being right. As I come to the end of these thoughts, I notice how different this question feels now compared to how it would have felt to me decades ago. Back then, I would have wanted an answer that resolved uncertainty, something firm enough to build a position around, something that allowed me to say with confidence, this is what will happen. Time has taken that desire away from me, not by replacing it with certainty, but by showing me how little certainty is actually required to live and decide well. When I look back, the moments that mattered most were not the moments when I correctly anticipated an outcome. They were the moments when I adjusted my thinking in response to reality, when I let go of a view that had once made sense but no longer did, when I accepted that the world had changed or that I had misunderstood it and chose not to defend myself against that realization. That is how I think about the future of the dollar. Not as something to be right about, but as something to observe honestly, to hold within a broader understanding of cycles, incentives, and human behavior, to recognize that dominance and decline are not opposites, but phases that can overlap for long periods of time. A system can function well while becoming less forgiving. A currency can remain central while facing growing constraints. What has become clear to me is that the greatest risk does not come from any single outcome. It comes from rigidity, from tying your sense of safety, identity, or intelligence to one story about how the world must work. I've seen that mistake play out in markets, in institutions, and in individuals. It rarely looks dramatic at first. It looks like confidence, and then it looks like surprise. There is a quiet discipline in learning to live without needing the future to confirm you, to make decisions that are robust across many possible futures rather than optimize for one. That discipline doesn't come from brilliance, it comes from humility, from respecting how little control we actually have and how powerful small, repeated choices can be over time. If there is something you can take from this without effort, it is simply this awareness. Notice when you are seeking certainty because you are uncomfortable with not knowing. Notice when your questions are really about reassurance rather than understanding. In those moments, pause, not to withdraw, but to widen your view. That pause has saved me more than any forecast ever did. As I get older, I feel less urgency to explain the world and more responsibility to align with it, to stay attentive, to remain open, to keep refining the principles that help me navigate uncertainty without pretending it isn't there. Those principles were shaped by being wrong, by reflecting honestly, and by accepting that progress is not a straight line. I don't know exactly how the story of the dollar will unfold. I know it will unfold through choices made under pressure, through cycles that echo history, and through human behavior that changes less than we like to think. Understanding that has made me calmer, not because the future is safe, but because I am less attached to needing it to be. Pain plus reflection equals progress.